Welcome back to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. And I am by my lonesome for this portion of the show as David had to take off. However, wanted to follow up a little bit on what we talked about starting in the first half of the show, which is earnings announcements that have been starting to come across the board. We started looking at bank stocks. We were discussing bank stocks earlier in the show. That information is coming across, and it's been largely positive as expected. No real surprises there. That overall tends to bode really well for the markets in general, for the economy in general. Why is that? Because if banks are doing well, it's typically because we're seeing a spread in interest rates. We're seeing more lending going on. We're seeing more borrowing going on. It's an overall positive indicator, forward-looking for the market. So that's been very good. The next companies that we'll hear from will be industrials. That's also expected to be extremely positive, especially in light of, well, two things. One, in light of the tax changes that are coming down the pike, and also the fact that there's expected to be significant investment in the infrastructure in the United States in the coming years, which should bode well for industrials as well. So that's expected to be positive. Technology is also expected to be positive. I mean, sector by sector, we really are looking at positives across the board. Energy is a bit of an X factor. I'm actually excited to see what's going to be coming down the pike with that because there's so many variables impacting energy companies. Pharma is another one that is definitely a little bit questionable from a sector perspective. You have some real winners and some real losers, and that sector is changing quite a bit. We expect to see a lot more M&A or mergers and acquisition activity coming in the coming year as well, especially as we see some of these companies' stock prices really going into orbit. That's going to be good for M&A activity. So there's just a lot that is coming down the pike that still remains positive. And as we were saying earlier in the show, in a way it's frightening. It's also it's of course extremely it's extremely positive. It makes for much easier meetings. It makes for much easier conversations for clients that are actually planning and looking forward to retirement right now. It's wonderful timing. And of course, as we said before, we don't have tomorrow's newspaper, but this is very fortunate timing. And I think that there's a sense of optimism that is out there, which means that we will be seeing more people start to retire, partially retire. You'll see more of the baby boomers that had been waiting on the sidelines start to retire in greater numbers. That's definitely happening. You can see it happening here locally with the large influx of home builds that are happening specifically out in Bluffton. It's just amazing. So all of that is going to be coming to fruition, and you just can't get out of the way. On the other hand, and this is something that I'm hearing a lot from clients in our annual meetings, is how do we go ahead and lock in these gains now? Well, to most clients, what that means is sell everything and get out of the way, when really that's really not necessarily the best thing to do, because we're still watching this massive momentum that we want to make sure that we're on board for. And also, if we do see inflation start to tick up, you'll have to be invested in the markets in order to make sure that you're keeping up with just the cost of goods. So some things that we're talking about now. We are taking some cash off the table and reallocating it elsewhere. We're removing some risk from people's portfolios. We're definitely primarily steering clear of bonds. There's still some rationale for being there. However, in this interest rate rising environment, that's a little bit more tenuous than it's been in the past, and it carries a little bit more risk than it has in the past, or typically does. But those are definitely conversations that we're having now. The other part of that conversation that is really important is looking at expenses, because one side of the equation when you're looking at putting together a plan, when you're looking to retire or looking for any big change, is of course, what are my resources? Do I have a pension? What does Social Security look like? What kind of investments do I have? What kind of income can they yield? What's reasonable? What's unreasonable? What's my risk tolerance? All of that stuff, those are all questions that I can help answer. What we also need to know, and some of the real digging has to come into what are the expenses going to be? Because of course, that is primary, and we can't just generate funds without knowing exactly what it is that's going to be needed, or we can't do it in a smart way without knowing what's going to be needed. So having those conversations now with clients about what they expect expenses to be and really starting to visualize and put some of that that vision in place has been really, really helpful in light of this positive market, because people are looking to make change. They are feeling optimistic, but we need to make sure that we're planning according to those specific parameters. So that's been a great part of the conversation. And again, I mean, we're taking advantage of this wonderful opportunity as best we possibly can, but trying to do it in tandem with looking at what's realistic from an expense perspective too. A few other things that that clients are looking at. Obviously, health expenses is a big one as we're going into the new year and having more clients that are looking to fully retire or partially retire. For those that aren't yet on Medicare, or those even that are on Medicare, looking at what overall health costs are going to be in a long-term plan is a tremendous aspect of a plan. And interestingly, for somebody like me, there's actually a good number of software that's coming on the market that you can answer a certain number of questions about your health, your family history, health history, and this software will spit out what your expected costs will be with long-term care insurance, without long-term care insurance, for assisted living, if you have longevity in your family, what that's going to mean. Obviously, there's so many variables, and none of us know exactly what's going to happen, but it is really fascinating software to look at, especially if you do have longevity in your family, as so many of us do more and more so now. When we look at, okay, if there's a decent likelihood that I'm going to be alive when I'm 93, 95, 99 years old, what's that going to mean for my overall balance sheet? What's that going to mean for what my costs are going to be, or the cost to my family, and how do I plan for something like that, versus if I'm not in particularly good shape right now and I think that I'm going to have really high expenses in my 60s, and then I might not make it to 70. What is that going to look like from an overall cost perspective? So that's a really, really interesting factor that we're seeing a lot more tools and a lot more research being done around. So I'm sure it's some questions that you're asking yourself, and it's definitely worth taking a look at some of this. Again, none of us know for sure, but giving ourselves some sort of a window to be able to look into what the likelihood is of life costing X and life costing Y is very helpful. So those are a couple of really practical things that we're seeing coming into 2018. Another really practical thing that we're seeing is around mortgages, and I wish David was here for that, but individuals that are not necessarily trading up. The idea of getting that new trade up home is not necessarily the norm anymore. I think that the new norm is actually tends to be on the more average size home, not necessarily the gigantic home, but with all the nice amenities. So we're seeing a lot more refinancing. We're seeing a lot more money going into renovations, and using these really low interest rates to take advantage of that, to create the home that you want in the home that you already have, versus going out and getting that new move up home. So that's been really interesting as well. So those are some of the main points I just wanted to talk about in David's absence from a planning perspective. We're looking forward to a very interesting 2018. Certainly 2017 had a lot of surprises, but we're looking forward to joining you in 2018. Please send us all of your thoughts, ideas, comments, questions. We love getting comments on Facebook and email, phone calls, and just knowing that you're out there watching and have questions. If there's anything that we can help with, we love hearing from you. So until next week, this has been Money Matters. Have a wonderful week.